Hey, what's up, everybody? It is Monday, October 21st. I'm not wearing a cowboy hat, but I am wearing this World Series 2024 New York Yankees, LA Dodgers. You can see whose side I'm on, who you got. I think the Yankees are going to get it done. It should be fantastic. I'm really excited, looking forward to this World Series. It's been, 15 years since the Yankees were last in the World Series, and it has been 43 years since the Yankees and the Dodgers met in the World Series. I can remember even the 77 and 78 World Series, 1977, Mr. October, Reggie Jackson. It's going to be great. These are always great World Series. Who you got? I want to know. All right, let's get into it. I've been getting a lot of questions and comments asking me to make some comments about gold. I'll gladly do that. As you know, I don't have to tell you, like, gold's been going up every single day. Just as a recap, if you've been following me for any length of time, and certainly if you've been a subscriber for any length of time, you know that back in March 2022, I was pounding the table on gold. We were down at $1,600 an ounce. I said, you got to buy it. This is a very, very tiny short position that producers had. One of the smallest short positions in many, many years. And for them, that was an extremely bullish posturing in gold. You had very low interest on the part of funds, these large speculative funds. It took a little time, but that was an incredible moment to be buying gold. And as they say, the rest is history. Last year with the rate hikes, I said I remained bullish on gold. There were many updates that I sent out in my report and also in emails that I kept giving levels that you can buy it. However, recently, as you know, I have not been as bullish. In fact, I turned bearish on gold. Not like severely bearish, but I think this is very, very much overdone right now, this rally, for a number of reasons. My main analytical framework for gold, and it always has been this. I'm not one of these people who say like inflation hedge, blah, blah, blah. I mean, we've seen inflation come down. Gold's been going up. My main analytical framework for gold is economic activity. I believe that gold is economically sensitive. The main demand source for gold is still jewelry by far, even though, we've had more investment demand and central bank demand, but still jewelry demand, which is economically sensitive, that is by far, that's still by far the biggest component of gold demand. And, that's an economically sensitive type of demand. So, as you know, my outlook is for a slowdown in economic growth, possibly even a recession, depending on how significant the fiscal drag is now going forward and into 2025. Maybe have to consider the policy response after we get through the election, what's proposed, what's passed, etc. But right now, let me just inject something in here, because although my macro view is like, I like gold, but I never, and this is not what I'm about to say is not just applicable to gold. It's applicable to the way I conduct my investments. I never chase after anything. And I've had these conversations here, and I've talked about this many times on my channel, and I've gone back through my own personal history of, my trading, my investments from the early days when I got started, even as a floor trader and stuff like that. I learned a lot of valuable lessons because I made all the mistakes. And one of the biggest mistakes, or the set of biggest mistakes, fell into the category of chasing after prices, whether that be prices running up or prices going down. And I know a lot of people fall into this trap because they get emotionally involved, and it's like the FOMO instinct that kicks in, the fear of missing out. They see prices run up, they wait, runs up more, and then they can't stand it anymore. It's a lack of discipline, it's a lack of self-control, it's total emotional behavior. They chase after it. Or on the downside, prices go down, and they get scared, they go down some more, they get more frightened, and then they panic and they sell out, and that's ultimately like the bottom or very close to the bottom. I've been able to discipline myself over the course of my career, where I just don't chase, because when you get old enough and you've been in this activity long enough, you understand that there's always going to be another opportunity. I've said many times, like in the early days of my career, when I had something planned and it happened, and I ended up like not making what I thought I should make off of that, that move. I thought that was it. I was never going to see something like that again for the rest of my life, and that was my opportunity for my life has come and gone, and that's it. I might as well go on and do something else. But that's just not the case. There's always going to be opportunity. So I understand this, and I don't need to chase after everything, and I don't need to be greedy. Like, I was buying gold like way a long time ago, and I had gold stocks, I had gold positions. I took profits on that. My outlook right now, and again, let's get back to the macro thing. My outlook right now is that I think economic activity is going to slow. I think there's a good chance we could go into a recession next year based on the increasing fiscal drag that I've been talking about. Right now, I see, if you look at futures commitments in gold, by far, the long positions are held. I think it's a record long position on the part of speculative funds. And you have a very significant short position being held by gold producers and banks. And typically, that is not a picture which paints an enduring, bullish outlook. I mean, I often say, and you guys know if you've been listening to me, like, I never go against, when it comes to a physical commodity, I never go against the producers. That doesn't mean they're going to be right in an instant, okay? But over time, they're going to be right. They know their market. They're involved in the production, the merchandising, the distribution of their commodity. They're much more savvy than speculative funds. And so, I mean, I learned that as a trader on the NYMEX executing business for oil companies, and I saw what they were doing. And, they were contrarian by nature. They were on the opposite side of speculators, and they made money every single time. Maybe not immediately, but they made money every single time. And the other thing to consider about producers is that they're very hard to squeeze out of the market. And when I say that, it means like, if they're in a quote unquote bad position, it's very hard to squeeze them because they have the physical on the other side. So they're very patient. And what I see right now in terms of commitments, and that's not the only thing, like, I'm always going to come back to the macro picture. All right. And for me, the macro picture from now until into next year. And again, one little qualifier here. I want to see what happens in the election. I want to see what economic policies get proposed. I want to see what economic policies get passed by Congress. Even got to see how the Congress ends up after this election. But right now, if I were to, draw up a plan, draw up a strategy, I would say that next year we're going to look at slower economic growth with a very strong potential of a recession. And believe me, and we're going to, like I always say, we're going to go back and revisit this. We're going to have if we have a recession, gold is going to be much lower. Now, does that mean I'm like forever bearish on gold? No. I think gold is an interesting trading play Maybe you should always have some physically. I don't know. I don't own any physical gold. When gold prices go down to a point where I think it's attractive, I tend to own gold stocks like Newmont Mining or GLD, the gold ETF. I just don't own them right now. And one more thing, if you've been a subscriber to my report, MMT Trader, there has been over the last 5-6 weeks weekly points or levels I have given to my subscribers where you can buy gold at pullbacks. I noted where the producers were buying on these small pullbacks. I just came out with the report, yesterday, which put 2650 as a support level if we go back down there. And the week before I had another one, I think it was like 2635. We got down there, we even got below there. You could have bought as a trade and it went back up over 2750 something, maybe today 2760. So it's definitely tradable within the macro scenario that I have. But some of you wanted clarification. Yes, I'm not chasing after the price right now. I'll stand back. I'll wait for it to pull back. When it comes down to, and it will, believe me, it will. Listen, I'm old enough to remember that in 1980, when I first started out, actually I started out in 1979, in 1980, gold hit a then record high of $850 an ounce, okay? Remember, in 1971, Nixon took us off the gold standard, the international gold standard, and gold, prior to that, gold was pegged at $35 an ounce, and Nixon took us off, and from 1971 through 1980, okay, a 9-year period of a bull market, gold went from $35 to $850, and once it hit $850, it took, I think it was like, so that was 1980. I think it took something like 27 years for gold to regain 850. And I'm not saying that that's going to happen again this time, but I will say that this time, depending on what the fiscal landscape looks like, and given the fact that I think we're going to have this kind of like some permanent fiscal drag without any significant policy changes, and not permanent like forever, but like lasting for a while, I think we could have a gold correction that's not only deep, but pretty long lasting, okay? Where a lot of people who are buying now, they're going to lose money and they're going to give up on their hope. We're going to get back to an environment where I remember gold stagnating at $250 an ounce for many, many years, okay? And I used to write about this, and I used to talk about this. I used to give talks about this where gold, I kept saying, gold was below the cost of production. The price of gold was below the cost of production. And I said, it's just going to shut down all mining activity. And that's what happened. And you had a period where gold production dropped so low. And then, once demand started to pick up, which was like in the early 2000s, that's when the bull market started to develop again. So, but I remember this so well, that gold at 250. I mean, I was a COMEX trader. I was a gold trader. Okay? And every big fund and every big Wall Street, I remember being on the floor of the COMEX back in the early 90s. Okay? In New York. And every time there was a rally in gold, you had every big fund and Wall Street bank coming in and crushing that rally, selling it like crazy. I remember this, I mean, like it was yesterday. You had Goldman Sachs and Morgan Stanley and Merrill Lynch at the time and Solomon Brothers at the time. They just would every single time. And, you know, we all thought, oh, this was going to be the time that gold was going to take off. They were crushing it. So now we've gone on this, you know, a lot of this rally has been justified. And I say that because I was bullish on gold going back. And I said the fiscal was going to support the gold rally. Okay? But remember, we have seen recently the drop in net government transfers. That is going to continue. I've been talking about the interest rate cuts, which are going to lead to interest income transfer reductions. Less interest income being pumped into the economy. Those things are not bullish environments for gold. So just, you know, if you want to trade it, like for $50 or $100 right now, I have that in my report every single week. I tell you, you know, it's not like the producers are just selling all the time. Sometimes they've been buying a little bit on the dips. They show you their hand. They show you where they're buying it. And I say, look, they're buying it here at this level or this level. So you could jump in during the week and buy it at that level. And I tell you, they're selling it up at this level or this level. And, you know, you buy it there, you can sell it up here. But in the macro view, I wouldn't touch it right here. I wouldn't touch it right here. Anyway, that's what I want to say about gold. What else? Some of you have a hard time, I think, understanding this concept of, you know, government spending and money. I've tried to explain this in a number of ways. You know, I've used the swimming pool analogy. Like, you cannot drain a swimming pool. You have to fill it up first before you can drain it. Okay? You got to fill the pool up. You can't, if a pool is empty, it's already drained. If you're talking about taxes, it's the same concept. The dollars have to be put into the system before the government can tax them away. And the only way the dollars can be put into the system, the government has to spend those dollars into the system. Now, somebody might say, well, Mike, it's not the government, it's the Fed, which essentially is still the government. But let me just clarify something, that the Fed cannot give dollars to the Treasury. It's prohibited from buying securities directly from the Treasury. The Fed buys securities in the secondary market. That means it buys securities that were already sold and bought by the economy, by people, by actors, by participants in the economy, by investors, by primary dealers. The Fed buys from them. So it's already, the money was already put there before the treasuries were even sold. I've used the example of the Monopoly game. You can't play the Monopoly game until the game distributes the money to the players. Then if you go around the board and you land on Community Chest or Chance, and it says pay $75 tax, all you're doing is giving back some of the money that was already distributed by the game. Now, I know people hate to hear this, and I understand it, because it's like, hey, I got to pay taxes. It feels like I'm giving money to the government. Yes, in a way you are, but what you're giving is what, you know, is a little piece of what has been distributed. How does the government distribute that money into the economy? Various different ways. It buys goods and services. What kind of goods? Well, the obvious thing, it buys military goods. It buys, you know, all of our defense expenditures, aircraft carriers, airplanes, tanks, munitions, ammunition, all this kind of stuff. Services, it pays soldiers, you know, government workers, this and that. I mean, you could argue politically that, hey, we shouldn't be spending on those things. That's a political argument. The government transfers money into the economy because it is the taker, it is the user of services and goods provided by the private sector. And the private sector is the taker, the user of the government money. Okay, why? We need it to pay taxes, all right? So, like, you have to understand, somebody also said that Social Security is a scam, okay? We got to give our government money, and then they give it back to us well, it's kind of like an annuity, all right? But I agree with what that person said in this regard. It's not necessary to tax. By the way, all those taxes that are taken out of your paycheck, like in FICA and all those things, those go into the Treasury's regular account called the general account. And that's used for general spending. That's not like stored somewhere in some lockbox. Remember, what's his name? I forget. It ran for president. Was Clinton's vice president. Al Gore, he said, we're going to keep it in a lockbox. There's no lockbox. All of that money taken out goes into the Treasury general account used for general spending. And so it shows you right there that it's not necessary to tax people for Social Security. All right, we every year we hear all this, Social Security is going to run out of money. It never had any money. The government just, it makes those checks, it sends out those checks, or it credits your bank account because it has the power to do that. All right? Taking that money out of, and by the way, Trump is proposing to end taxing Social Security, which would be huge. That would be huge because that would leave so much more money in people's paychecks every month. You want to talk about a very simple economic stimulus, it would be that. And that is not regressive. You know, that's something that'll help ordinary working folks. It's not like a tax cut for the rich. I mean, that's like a fantastic idea. It's something I've been saying for a long time. If he actually does that, if he's able to do that, if Congress goes along with that, I mean, that would be amazing. That really would. I would have to reevaluate my economic outlook if he happens to do that. Anyway, man, it was a long video. Please like and subscribe if you choose to, if you ended up coming this far. And don't forget, go to my website, pitbulleconomics.com. Sign up for a 30-day free trial to MMT Trader. And go Yankees! Or Dodgers if you're a fan. Let me know. Bye.